Yes, yes, it does. A bit of a follow-up question. You mentioned about having clients with Western views and having clients with Asian views. Is that hard to navigate the cultural differences, the difference in cultural values?
Not really, Tico, because at the end of the day, especially if you're goals-based type of, if it's more of a goals-based type of approach, as long as they understand or they appreciate the fact that you understand their goals and you understand how they want to, where they want to land, I think those subtle differences go away really, because at the end of the day, what's very important is that we achieve what they want to, what they set out to achieve in the first place. So, for instance, if I can give you an example, right? If I see a client, say a Western client that's an expat, so I do a lot of expatriate work, as you can imagine, in Hong Kong. He says the profile is he's 50 years old, he's my age. He wants to retire in 10 years' time, back in Australia at age 60, right? So I put him into some kind of investment program, and then every year, then we look at whether how that portfolio is doing, right? As you know, with markets, especially this year, right, things are very, very volatile, right? So you can't really promise them, returns that are quite significant. Because it's not, I'll tell you right now, 2025 is not going to be that kind of year, right? But if you look at, their goal of, still investing in 10 years time, then you talk about things such as, you have a long investment horizon. You're not invested just for 1 year, you invested for the next 10 years. So notwithstanding that it's very volatile at the moment, understand that your goal is, in 2035 rather than now. So you can still afford some of this volatility that's happening. So giving them that understanding that what investment markets are doing and how it relates to their goals is very, very important.
Yes. Are clients usually that demanding?
Oh, all clients are demanding, right? If you give me one example of that, who are not, the thing is, right, we have to be demanding of ourselves as well, right? In terms of being able to do the best by our clients. So yes, clients are demanding, but they're paying us, right? We don't come for free.
So to follow up on that, like in your long career, you must have had some pretty bad clients that. Can you tell us more about like how you handle them?
Sure. So with bad clients, right? I mean, that's all clients are the same, right? What it is that whether they had good experiences or bad experiences, right? In terms of their, the investment side of things, or how their portfolio has been managed, etc. And a lot of that can probably be solved by really being, providing them with clarity more than anything, right? So if they are clear of exactly what you do and what you can do, and things fuck up, right? Sorry, things will actually go wrong, right? In a lot of cases. It's not, nothing is perfect. There's especially, I mean, how many times have you gone to your local bank and things are too long, the line to the cashiers taking too long, or they've misspelled your name and all these things. It's very annoying, right? And so you're not getting a really good experience. It's same in the wealth management side of things. Even though I deal with a lot of high net worth people, there are things that often go wrong, especially from an admin perspective. The way to actually deal with that is, one, you really need to acknowledge that they have had a bad experience, number one, and number two is you put in steps and implement steps that solves it straight away, and keep them informed, right? Because at the end of the day, we're in the relationship business, right? It's not really about the mistake, but it's about how you can solve it, right? Because mistakes will happen, I guarantee, right? In terms of client relationships, etc., etc. So it's really more about relationship rather than anything else.
Andre, can I just jump in one question on that point? Can you hear me, Mike?
Yeah, sure. Loud and clear, Mike.
About at the end of the day, when you advise clients, you should pursue this type of portfolio, this kind of investment, and that things. You have to have some sort of accountability, right?
Yes, yeah, correct, absolutely.
The client will ask, why, for example, if things go south, whatever, why this isn't work, okay? And obviously, I should that many times you will encounter this kind of thing, yeah. And my question is really, how the accountability in this kind of professions, yeah?
Yep, sure. So very good question, Kai-chan. So what happens is that, as part of what we call the advisory process, we do a very deep dive in terms of knowing the client, KYC. You probably heard of that phrase, right? Know your client. So know your client is not only looking at their identification side of things, but know your client would be knowing exactly, where the client is from a financial perspective. So in terms of what their assets are, what their liabilities are, what their goals are, what their risk profile is. So we do a risk survey just to make sure that the investment we put them into is aligned with their risk preferences, whether it's defensive or it's growth, what type of portfolio that they would like to align. But again, most importantly is what their goals are. Because say, for instance, if their goals are, I'd want to retire in 10 years' time, the investment solution that I give will be very different to someone that says, I want to start an income stream in 12 months' time. Because of the timeline, right? The volatility that's involved in the portfolio design will be very different. And the other part is, the reason why we do a very deep dive of this fact find, if you like, is exactly what Kai-chan is saying in terms of the accountability piece, right? So I'm licensed in Hong Kong and in Australia as an advisor, which means that I get audited, and every file that's audited, every client file that's audited, I need to prove that I've met what's called my fiduciary duty. My fiduciary duty means that, in everything I do, I need to make sure that I'm doing it for the best interest of the client. So there's also, I guess, a compliant, requirement in my role, making sure that, the accountability test is met. And the second part is, yes, for instance, if the markets are down, but, your client has an aggressive risk profile, which means that an aggressive risk profile means that you are more than likely are invested in volatile products, not just equities, Asian, US, S&P 500, whatever it is, then that's okay. That's type of the risk that you have, the risk that you take when you are investing in those sort of things. So I think to cut a long story short, it's really about knowing your client really, really well, knowing their goals and objectives, and just guiding them along that journey, if you like, making sure that they're comfortable and clear of their goals and what's happening with their portfolio.
So you mentioned that you deal with a lot of high net worth individuals, right? Thing is, we're not that high net worth individuals. So how would we suggest that? And most of the time, we barely have any income. The only thing we worry about is maybe like, what do we eat for lunch? That's the one thing that we got on our mind. So how do you think that we should manage our money with limited funds? Do you think that we should start investing, or should we just experiment ourselves?
Good question, Pranav. Now, we've all been in your shoes, right? I remember my time in university in Sydney, exactly the same, right? You're living from, week to week, just making sure that with that little money that mom and dad sent you, what can you do with that and have a bit of fun, right? That's no issues at all. So the idea really is, again, interestingly enough, the idea is not about where to invest, but is understanding yourself. What are your goals? Right? What are your goals? Are your goals to make sure that there is enough budget for a month, or are your goals to buy a new laptop at the end of 12 months, right? Or is your goal, because the thing is, right? If someone goes to me and says, Andre, you know what? I want to invest, right? Well, yeah, great. You can invest if you want, but what's the purpose? What's the end point? What does success look like in that terms of investing? Is it for, you want to invest to start making inroads for deposit of a property, for instance, right? So, because if that's the case, then I suggest, you give yourself more, a longer time horizon and invest things that are more volatile, aligned with that time horizon, right? But for instance, if you want to invest for, I guess, a trip overseas in the next 12 months, right? Then that's pretty easy. 12 months, just try to find the right term deposit because it's safe, it's liquid, and hopefully if you actually contribute enough every month, then you'll probably reach your goal. So again, it really comes down to understanding what your goals are, to be honest, Pranav, rather than where to invest in. Where to invest in would then, but then if pressed in terms of where should I invest, Andre? That will come down to the investment horizon that you have. 5 to 10 years, you invest in equities. 1 to 5 years, you probably invest in cash, term deposits, fixed interest, bonds, whatever it is, right? Because you'd need liquidity at the end of that time period. So again, I hope I'm stressing this enough that you really need to find out what the financial objectives are, and the investment is a tool, right? The financial objectives is what drives it.
About investments, there's one thing called the robo advisors. Do you think that we should trust the robo advisors, or do we not believe that? Because in apps like Vivid, they have the robo advisors.
That's a good question. Now, I knew AI was going to be part of this discussion, but the thing is, right, with robo advisors, etc. Take a step back. My thoughts of AI is as such, right? AI stands for artificial intelligence. For me, it just means access. It actually stands for access to information, right? It's not really about this. It's more of a support system rather than a competition, if you like, right? So especially, say for instance, if you say robo advisors, the reason why robo advisors can be used is because it can be used to advise people in a very limited capacity, right? Because to Pranav's question, if I have $100 US per month, which is around 1 juta, right? A million a month, where would I invest in? A robo advisor would then ask you for your timeline, right? How long would you like to invest? It'll ask you about what your risk preferences are, right? And then give you some type of product solutions at the back end, right? So it's very, very, very simple, if you like, in terms of the solutions that it gives you. Now, whether you should trust it or not, it really comes down to whether you have time to actually do it yourself. Because the other part of AI and everything like that, it's supposed to be a time saver, right? It's supposed to help you, right, Steph, to do other things rather than having to worry about your investments type of thing, right? So for me personally, we don't do robo advice because obviously it's on the lower scale of investing, right? But in terms of if you like tech, if you like to save time, then yeah, you probably want to have a look at it. Personally, you guys know what an ETF is? Exchange Traded Fund? No? Okay, cool. You know what shares are, right?
Yeah.
And you know what an index is, right?
Yes.
Okay, so you have the ASX 200 index, S&P 500 index. An ETF, an exchange traded fund, is a share that actually can buy a replication of those indexes. So rather than you buying 100 companies in the American Stock Exchange, you just have to buy one share, right? Have a look. The reason why I'm bringing it up is because it's very, very cheap. I think it's relatively new in the Indonesia market, but it really gives you really good exposure to different the in a very, very cheap manner. It's very, very, well, cheap is relative, but it's very, very cost effective. I'd rather do that rather than put your money into the robo advisor side of things, because then you'll be able to research, do your own stuff as well.
So do you think that we should leverage, like, let's say we want to invest, do you think it's better to invest in our own countries, let's say stocks, for example, or in international companies? Because sometimes in Indonesia, the growth rate cannot really be measured as effectively as like in other regions, right? And you might end up being more profitable if you invest in other regions. What's your take on that?
Good question, Pranav, because as you know, with asset classes, right? There's the main asset classes being equities, fixed interest, cash, property, right? And then within the equity subsector, you have the local equities, you being Indonesia. Then you have Asia, Europe, US, China, et cetera, right? I mean, the rule of thumb of diversification is the more diverse your portfolio is, the less the risk, as you know, and you lessen the volatility as well. So the answer to your question is quite clear in terms of if there is scope to diversify outside as well. A very quick note in terms of Indonesia, a disclaimer, I don't deal too much in terms of investing in direct Indonesian stocks. I don't really understand the layabout of that. But what I do know is that if I was sitting as an investor in Indonesia, I would probably diversify my assets outside because of two things. One, currency risk, right? The rupiah is seen as an emerging country risk, so it's volatile as well. And also, I guess, I'm trying to put this in a way that's not offensive. Geopolitical, if you like, right? I think that's the best way to put it in terms of, it's I think there are other regions that probably has more of a stable infrastructure than Indonesia for now anyway. Obviously, things will improve, and they should. But for the reason anyway, you'd need to diversify outside of Indonesia if you have the potential to do so.